For most of modern market history, investors had a tailwind they barely noticed. More people, more workers, more households, more demand. That simple engine lifted economies, real estate, and stock markets for generations. But that rulebook is breaking. In this video, we'll look at population trends investing, where the new pockets of opportunity are forming and how smart investors can position themselves before the market fully adjusts. The United Nations projects global population will peak at 10.3 billion in 2084, then start to decline. And we don't have to wait for that peak to feel the effects. Global population growth has already fallen from 1.7% in 1950 to just 0.8% today. The IMF estimates this will drag global output growth 1.1 percentage points below historical norms between 2025 and 2050, with demographics driving nearly 75% of that shortfall. So what does this mean? Not that markets collapse. It means easy growth gets harder. Passive, broad market strategies that worked when everything was rising, those will deliver less. Picking the right sectors, the right regions, the right companies, that will deliver more. Future returns won't come from simply buying the index and waiting. They'll come from understanding where growth still survives. Most people aren't afraid of a population chart. They're afraid of what that chart does to their life. Retirement, taxes, healthcare, housing, the social contract itself. That's the real pressure point. Across the OECD, the old age dependency ratio was 19% in 1980. By 2023, it had climbed to 31%, roughly 3 workers for every retiree. By 2060, it's projected to hit 52%. That means fewer than 2 workers supporting every retiree. And that support flows directly through taxes, pensions, and healthcare systems. Meanwhile, the working age population is expected to shrink by 8% across the OECD, and by more than 30% in over a quarter of member countries. Fewer workers, more retirees, a heavier burden on every tax base. That's the squeeze. So what does this mean for investors? Many promises people assumed were stable may have to be repriced. Not in one dramatic crash, but in a slow, grinding shift. Pension systems get strained, healthcare costs rise, tax pressure builds, and housing in aging, slower regions may stop behaving like a guaranteed one-way bet, where prices were once carried by a constant flow of new families, new workers, new buyers. In an aging world, scarcity doesn't begin in the stock market. It begins in the worker base the market depends on. Fewer workers means fewer people producing, paying in, and holding the system up. And when that base weakens, everything built on top of it has to adjust. Many people hear population slowdown and picture one uniform collapse. That's not what the map shows. Demographic pressure is real, but it's uneven. Some countries are aging fast, shrinking slowly, struggling with weaker household formation. Others still have a powerful growth engine running. Cities filling up with new workers, new consumers, new demand. The research is clear. India, Nigeria, Pakistan, the DRC, Egypt, Bangladesh are expected to add more than 500 million city residents between 2025 and 2050. That's not a footnote. That's a new center of gravity for housing, transport, logistics, finance, and digital infrastructure. Population-driven demand isn't disappearing, it's concentrating. And for investors, that changes everything. The old approach, own a bit of everything and let the tide carry you, no longer works the same way. The new approach is simpler to say, harder to execute. Go where the people are going. Here's where the story gets more interesting. Fewer births don't automatically mean economic decline. That's the part most people miss. The real dividing line is productivity. Can a country or a company keep generating more value with fewer workers? In an aging world, that becomes the new growth engine. The IMF points to one of the most underappreciated facts in this story. Healthy aging alone could add 0.4 percentage points to global GDP growth between 2025 and 2050. A person aged 70 in 2022 had the same cognitive health score as a 53-year-old in 2000. Older workers are staying in the labor force roughly 20 percentage points longer and earning about 30% more than previous generations did at the same age. Aging doesn't just create pressure, it rewards adaptation. Countries that keep older workers healthy and productive can soften the blow. Companies that help businesses produce more with fewer people become indispensable. That's why automation, robotics, enterprise software, and labor-saving technology matter so much right now. Not because they sound futuristic, but because in a worker-scarce economy, they become basic infrastructure. Productivity is no longer optional. It's the replacement for population growth. When you bring all of this together, one thing becomes clear. This trend isn't creating winners everywhere. It's creating a specific set of them. And those winners can be grouped into 3 buckets: automation, longevity, and urbanization corridors. Understand those 3, and you understand where demographic pressure turns into opportunity. Bucket 1. Automation and labor-saving technology. As workers become scarcer, the value of tools that help companies maintain output with fewer people goes up. Robotics, industrial automation, AI, enterprise software, systems that remove labor bottlenecks. The winners here aren't all tech companies. They're the businesses that help aging economies do more with fewer hands. In a labor-scarce world, efficiency stops being a competitive advantage. It becomes a survival requirement. Bucket 2. Longevity economy investing. Aging doesn't mean spending disappears. It means spending shifts. More money flows toward healthcare, biotech, senior housing, medical infrastructure, and services that help people stay active and independent longer. Older consumers are spending on wellness, travel, education, and quality of life. And that's a major spending shift most investors are still underestimating. Bucket 3. Urbanization investment opportunities. While aging countries slow down, a smaller group of regions is still adding people at scale. That 7-country corridor, India, Nigeria, Pakistan, the DRC, Egypt, Bangladesh, and Ethiopia, is expected to add more than 500 million city residents by 2050. That's sustained demand for housing, infrastructure, logistics, digital networks, and financial services. The old world rewarded broad exposure. This one rewards targeted exposure to the places, sectors, and companies built for demographic change. The tailwind for investors hasn't disappeared, it just shifted into 3 very specific places. One of the most common counterarguments to demographic decline is immigration. And yes, immigration can ease the pressure, adding younger workers, making a country's population profile less top-heavy. But it doesn't restore the old model of endless labor supply and broad population expansion. The reason is straightforward. Population growth is concentrating in a smaller number of countries, which means more aging economies will be competing for the same pool of younger workers. Immigration is a pressure valve, not a rescue button. The strongest countries and companies won't be the ones hoping labor shows up. They'll be the ones built to function well, even when labor stays scarce. In a world growing older, that's the real competitive edge. So let's bring it all home. Future returns will come less from broad demographic expansion and more from assets built for a world where people are scarcer, older, and unevenly distributed. That's the shift investors need to internalize. The signals are consistent. A 1.1 percentage point drag on global growth, a 0.4 point offset from healthy aging, an OECD dependency ratio headed toward 52% by 2060, and 500 million new city residents concentrated in just 7 countries. The conclusion is clear. Don't rely on endless population-driven demand. Favor efficiency, favor longevity, favor selective exposure to the places where people and demand are still growing. Demographics don't kill markets. They redraw where the winners are. All right, which of the 3 buckets do you think holds the most opportunity over the next decade? Automation, longevity, or urbanization corridors? Drop it in the comments. I read every single one, and I'd love to hear where you're placing your bets. If this video gave you a new way of thinking about macro trends investing and where returns are heading, hit like. It takes 1 second, and it helps this content reach more people who are thinking seriously about their money. And if you want to stay ahead of macro shifts like this one, understanding the forces shaping markets and learning how to position yourself before the crowd catches on, subscribe. That's exactly what this channel is built for. See you in the next one.